All right, let's dive into a powerful investing strategy that can actually turn your stock portfolio into a real source of regular income. It's called dividend investing, and we're going to break down exactly how it works. So just think about this for a second. What if, instead of only hoping your stocks go up in value, they also sent you regular cash payments? You know, almost like a paycheck. Well, that's the core idea we're going to get into today.
So what even is a dividend? It's actually beautifully simple. When you own a share of a company, you're not just a number, you're an owner. And when that company turns a profit, it can decide to share a piece of that profit directly with you. That payment? That's a dividend. It is literally your reward for being part of their success.
Now, it's easy to think of dividends as, just a little bit of pocket change, a small bonus. But trust me, their long-term impact on your returns is, well, it's massive. Let's really look at the numbers here. This might actually shock you. Over the last 100 years or so, dividends have accounted for over 40% of the stock market's total return. That's not just the stock price going up, that's the whole shebang. So if you were only focused on price, you would have missed out on a huge piece of the pie. It just goes to show you, dividends are absolutely critical for long-term success.
Okay, and this chart, this is where it gets really wild. This shows what happened to $100 invested in the S&P 500 over 80 years. If you just let it ride based on price increases alone, that $100 grew to about $5,800. Not bad, right? But if you took every single dividend and reinvested it, that same $100 exploded to over $142,000. That is the incredible, almost unbelievable power of compounding at work.
And for investors who really value reliability, there's this elite group of companies called the Dividend Aristocrats. These are the all-stars. They're S&P 500 companies that haven't just paid a dividend, they've increased it every single year for at least 25 years in a row. We're talking about household names like Coca-Cola or Procter & Gamble, companies famous for their stability.
Okay, so the history is impressive for sure. But what does this mean for your portfolio right now? Let's break down the tangible benefits of choosing dividend stocks, or as I like to call it, getting paid to wait. So there are some really key benefits here. First, you get a steady passive income stream. And because solid companies tend to raise their dividends over time, that income can actually help you fight inflation. Plus, these are typically older, more established companies. That means their stocks tend to be less volatile. They don't jump around as much, which can give you a little more peace of mind when the market gets shaky.
We just saw that crazy growth from reinvesting dividends. So how do you put that on autopilot? Well, there's a secret sauce for that, and it's called a DRIP, which stands for Dividend Reinvestment Plan.
A DRIP is a super simple program that a lot of companies offer. It just takes the cash dividend they were going to send you and automatically uses it to buy more shares of that same company. And here's the best part. A lot of the time, this happens with zero commission fees, and sometimes you even get to buy the shares at a little discount. It's a fantastic tool. And this creates this amazing, powerful cycle. Okay, so first, your stock pays you a dividend. Then, the DRIP automatically reinvests that cash for you, buying more shares, even tiny little fractional shares. So now, you own more of the company, which means your next dividend payment is bigger, which then buys you even more shares. You see, it's a snowball effect that can really accelerate your growth over time. So I'm hoping you're sold on the why. Now let's get into the how. Building a solid dividend portfolio really doesn't need to be super complicated. In fact, there are a few simple, time-tested rules you can follow. First things first, diversification. You never want to put all your eggs in one basket, right? Well, for a stock portfolio, holding somewhere between 20 and 60 different stocks is generally considered the sweet spot. This spreads out your risk, so if one company hits a rough patch, your whole portfolio doesn't go down with it. And rule number 2 is about diversifying across sectors. Now, sectors are just broad categories of the economy. Think technology, healthcare, energy, that kind of thing. A really good rule of thumb is to not invest more than 25% of your portfolio in any single one of those sectors. It just keeps you from being too exposed to a problem in one specific part of the economy.
Okay, so let's just quickly recap the framework. Hold between 20 and 60 stocks. Keep any single sector under 25% of your total. Try to give each stock a roughly equal weight so you're not totally dependent on just one or two big winners. And, maybe most importantly, you want to target companies that have a long history of paying safe, reliable, and ideally growing dividends.
All right, one last thing, but it's a big one. Taxes. You gotta know this stuff because not all dividends get treated the same way by the taxman, and the difference can really affect how much money you actually keep.
So there are basically two types. You've got ordinary dividends, which are taxed at your regular income tax rate. That can be as high as 37%. Ouch! But then you have qualified dividends, and these get special treatment. They're taxed at the much, much lower long-term capital gains rates. We're talking 20, 15, or for some people, even 0%. And the great news is, most dividends from major U.S. companies are qualified, which is a huge, huge win for investors.
I love this quote because it really gets to the heart of the whole strategy. Current yield, that's the cash you get right now. Dividend growth, that's the raises you get over time. When you can find a company that gives you a good balance of both, well, that really is the holy grail. So to wrap it all up, look, dividend investing is not some get-rich-quick scheme. It is a disciplined, patient, time-tested strategy. It's about owning pieces of great businesses and just letting that power of compounding do its magic for you over the long haul.
And that really just leaves us with one final question for you to think about. Whether you're trying to save for retirement, generate some passive income, or just build some real, lasting wealth, could a steady, growing stream of dividends be the key that unlocks it all for you? Thanks so much for tuning in.